Hello and welcome to Stockwatch Live. Now, for a retailer to upgrade its profit forecast is something of a rarity in the current tricky trading climate. For homeware retailer Dunelm to have upgraded its profits guidance twice in as many months is rarer still. However, the company, which is one of the UK's largest homeware retailers, says it's thanks to the unseasonably favourable weather at the start of summer that has led to strong sales and boosted profits. Dunelm, which mainly operates out-of-town superstores, appears to have sidestepped the rout on the high street and says it expects to see pre-tax profits for the year ending on the 29th of June to come in between £124 and £126 million. That compares to the £102 million it made in the previous year and also tops the range it gave in an update in April when it said it expected to beat analyst forecasts of between £116 and £119 million. However, it's more likely to come down to clever strategic management rather than a run on cushions and curtains that's behind the stellar performance. Since he took the helm in late 2017, Dunelm Chief Executive Nick Wilkinson has streamlined the business, closing its underperforming World Stores and Kiddie Care websites and investing instead in Dunelm's core digital offering. Shareholders, who will be all ears when the group posts fourth quarter results on Wednesday, have been richly rewarded. Dunelm shares have risen more than 80% over the past year. Broker UBS is neutral on the stock, but has raised its price target to 930p. Elsewhere in the sector, we're also due to get the long-awaited full-year results from fashion retailer Superdry the same day. The Rad Dad brand postponed the announcement from last week, saying it needed more time to complete the accounts. Nick Gresham stepped into the Chief Financial Officer role on an interim basis in June, which could explain the delay. Superdry has seen some seismic changes, starting with its third profit warning in a year, which prompted a boardroom tussle that eventually led to an overhaul of its executive team. Co-founder Julian Dunkerton returned to the company at the same time as the group's interim chief executive and set about making immediate improvements that included increasing the range of items available online and in stores. Long-suffering shareholders will probably just want to hear the latest and get an idea of whether Superdry is indeed home and dry or another ailing retailer struggling to find its niche. Brokers are largely staying quiet until more is known. Only RBC Capital Markets has put its head above the parapet, repeating its sector performer rating but cutting its price target 20p to 500p. The shares are currently hovering around 460p. If Superdry's results make for sombre reading, then Thursday's trading update from Kier Group is unlikely to offer much to change the mood. In June, the UK government contractor said it was cutting 1,200 jobs and selling large chunks of its business as a crisis of confidence has left it with little choice but to pay suppliers in advance. The UK's outsourcing industry is still reeling from the collapse of Carillion last January and Interserve's takeover by creditors this year. Serco has made 2 failed takeover bids for Babcock, but the industry is braced for more turmoil. The latest steps taken by Kier, which employs more than 20,000 people on projects stretching from the HS2 rail project to rubbish collection, aims to ultimately streamline the business to focus on construction, infrastructure, utilities and highways. While that turnaround happens, it said it would suspend dividend payments for 2019 and 2020, cut jobs and sell assets in order to lower its debt. It aims to deliver annual cost savings of around £55 million from 2021. Currently just above 105p, Kier Group shares are a far cry from where they were at almost £10 a year ago. Broker Liberum Capital has retained its buy rating but has more than halved its price target, cutting it from 320 to 150p. And that's it for this week. For more on the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. Thanks for watching.